The West's major central banks all kept interest rates unchanged in recent days, but struck very different tones on the market's much-anticipated cuts in 2024. The U.S. Federal Reserve sent risk assets rallying on Wednesday when, alongside holding its benchmark rate at its current target range of 5.25% to 5.5%, the Federal Open Market Committee revealed policymakers were penciling in at least 3 cuts next year and 4 additional cuts in 2025. Markets are now pricing the first 25 basis point cut in March and expect the Fed funds rate to be around 150 basis points lower by the end of next year, according to CME Group's FedWatch tool. Although the 3 cuts signaled by the Fed were still shy of the market's expectations, it still presented a dovish surprise that sent the Dow to a record high and bond yields tumbling, with the 10-year U.S. Treasury yield falling below 4% for the first time since July. U.S. headline inflation came in at an annual 3.1% in November, still above the Fed's 2% target but down significantly from the pandemic-era peak of 9.1% in June 2022. However, the core figure, which strips out volatile food and energy prices, held steady at 4%. Meanwhile, economic activity has remained remarkably resilient, with GDP growing at an annual 5.2% in the third quarter. Fed Chair Jerome Powell acknowledged in his press conference on Wednesday that rate cuts had now begun to come into view, prompting a number of economists and major lenders to change their future rate calls. Among them were U.S. economists at Barclays, who had previously projected just a single rate cut in December 2024, but now expect 3 cuts at every other meeting, starting from in June. We were surprised by the FOMC's reluctance to push back against the notable easing of financial conditions over the past month or so, they said. Not only did the statement cite tighter financial and credit conditions, as in November, but the summary of economic projections also showed a slightly downgraded GDP growth projection for 2024 despite less restrictive conditions for aggregate demand. Powell expressed no concern that such easing might undermine the FOMC's objectives. Despite the dovish shift in the rate call, the British lender's economists assigned upside risk to its projections as the recent easing in financial conditions may boost growth and ultimately result in stalling disinflation. On the other side of the Atlantic, however, the picture is very different. Both the Bank of England and the European Central Bank on Thursday pushed back against market expectations, drawing attention to persistent domestic price and wage pressures. The Bank of England kept its main interest rate unchanged at 5.25%, but far from putting rate cuts on the table, said monetary policy is likely to need to be restrictive for an extended period of time. UK headline inflation fell to an annual 4.6% in October, its lowest point in 2 years but well above the bank's 2% target.